Yes, since I'm already into it. All right, so with this book to market anomaly, what this says is essentially high book to market stocks outperform low book to market stocks. And so when we talk about book to market, what we're really talking about is the book price of equity per share divided by market price per share. So what this anomaly really says is that if you were to take all the stocks in the market, let's say all 5,000 stocks in the US or thereabouts, sort them into 10 deciles, so 10 different portfolios, and then look at what happens when you sort those stocks based on their book to market ratios, what you would find is that the portfolio that has the stocks that have the highest book to market ratio, those stocks actually significantly outperform stocks that have the low book to market ratio. So actually, I may have shown a graphic in here. Yeah, here we go. Okay, this is the perfect one to look at. So this is actually from a pretty famous paper recently. But what these authors do is, here's the 10 deciles from lowest book to market ratio to highest book to market ratio over the last 80 years or so, or 90 years. And so what you can see here, what this really shows is that the stocks with the high book to market ratios, these would be considered value stocks. Historically, they've offered in this case, annual, yeah. So on average, 16.9% return annually over the last, over this period from 1926 to 2011. Whereas the stocks that have the low book to market ratios, these would be considered the growth stocks. Stocks like Netflix or Amazon, or some of those stocks that have that usually also have low PE ratios as well. So what this really shows is that if you want to build a trading portfolio or if you want to create a trading strategy, one of the good trading strategies that you can create is you can buy stocks that would be in this decile, so high book to market, and then short stocks that are in this decile. So that's the first one. All right, the second one, the size anomaly. So for this one, small stocks outperform large stocks. So for this one, I think I also have, yeah, perfect. Okay, so what this one shows is that if we take all the stocks in the US and we sort them again, but this time based on their market capitalization, so number of shares times the price per share. So Amazon would absolutely be in this 10th decile, same with Apple. Some of those penny stocks that no one's ever heard of, but they still trade. Some of actually penny stocks wouldn't really even be in this decile. But the smallest stocks on the NASDAQ, the NYSE, they're all going to be in this decile. And what this one shows is that once you sort stocks into 10 deciles and then compare their performance over the next year or so, the smallest stocks offer an annual return on average of 19.38%, whereas the largest stocks in the US, so Amazon, Apple, etc., over this time period, they offered about 10.86% return. So in other words, we see about a 9% difference annually, which is, just enormous. in terms of return. I mean, of all the anomalies, I'm not sure I can give you a bigger anomaly or a better trading strategy than this. Small stocks outperform large stocks. And so, so that's that one. Okay, so the long-term reversal anomaly, this is probably the most confusing one of all of them. It's also, of the three of these, the least well-known. So this one actually says that when we, well, it essentially says that returns over time, they actually reverse. So the long-term, okay, so what this long-term reversal anomaly essentially says is that if you sort stocks into portfolios, again, like the same 10 portfolios, but this time based on past performance. And I think I should zoom this in. What this says is once you have those 10 portfolios based on past performance, let's just consider the worst portfolio, so the bottom portfolio, the portfolio of stocks that underperformed over the last 6 months by the most, and then this portfolio of stocks that outperformed by the most. If you look at those stocks or those portfolios, after you form those portfolios, what we find is that the portfolio containing the stocks that underperform the most, that had the most negative returns, that portfolio actually over the next 35 months has cumulative abnormal returns. So think of this as alphas. It has an alpha or a cumulative abnormal return of about 20%. The winner portfolio, so the portfolio of all the stocks that had the best returns over the last 12 months, that portfolio actually underperforms the market. So think of this like the alpha. It has a negative 5% alpha over that next 36 months. In other words, this long-term reversal anomaly says step one, sort based on past returns, and form 10 portfolios. The worst performing stocks so the ones that did the worst over the previous 6 months outperform the historically best performing stocks over the next 36 months or so. So those are the three anomalies. Yeah, so that's that. I can also go over the momentum anomaly if you'd like.
I actually got that one.
Okay, perfect.
Thank you.
Yeah. We're getting pretty close to time, so let's see how many people are actually on this thing. Kind of curious. Oh. Okay, well, I guess we only have 4 people on. Yeah, that's the downside to an online class. Not a lot of participation. Okay, well, are there any other questions I can answer? I mean, I'd be happy to answer literally any question you have. Take a sip of coffee while I'm
Can
Okay.
you go over the how to use the market multiples approach to calculate the intrinsic price per like share of stock? It's in chapter 8.
Yeah, absolutely. All right, so it might be best if I create an example. So let's say also, oh, geez. And so let's say 20, 22, 26, and 1, 5. Okay, so let's say we have 3 stocks, the ones that you see right here. And we want, let's say we're trying to value stock A. So let's say we're trying to do something like this. Well, the way that we would work a problem like this is we know stock C's information. And the way we work the market multiples approach is we essentially take and actually, if you can't see what I'm about to draw, let me know. I wasn't too sure how this would work out today. So I'm just taking a chance. So I'll say all right, so what we have here is if we want to calculate the intrinsic value of our target firm, what we're going to do is we're going to take the earnings per share of our target firm, and then we're going to multiply that by some measure of the growth prospects of a similar firm. In other words, what we're trying to do here is we want to take some competitor firm like stock C, and we want to copy over some measure of their growth prospects of their earnings over the next, well, for the future, onto the earnings of our target. That's entirely how the market multiples approach works. If we have some number, it could be earnings per share, it could be book price per share if we wanted to. I'll show you that one as well here in a second. All we need to do is take earnings per share of our target firm, multiply it by the PE ratio of the competitor firm, and that will give us our intrinsic value of our target firm, which is, in this case, stock A. So in this case, what we'll do is we'll take the earnings per share of stock A, which is $1, and we'll multiply that by the PE ratio of stock C. And that will give us the intrinsic value of stock A, assuming that stock A has the same growth prospects of stock C. So I guess I should preface this by saying, oh, I don't want to do that. Uh, you can use literally any ratio you want. I mean, the only reason I use the PE ratio here is because, well, I was just writing the example here. But if you wanted to calculate the intrinsic value based on, let's say, book price per share, so the price to book ratio, all we would have to do is just take stock A's price to book and multiply it by the, sorry, all we would have to do, and I don't want to confuse you, and I'm pretty sure I just did, all we would have to do to get that intrinsic value for stock A is take their book price per share. So that's just the price or the total value of stock A's common equity or its equity on its balance sheet divided by shares outstanding. And then we're going to multiply that by the price to book of stock C. Now we have another intrinsic value. Now, a couple final points on the market multiples approach. First off, the calculations, we've just done all the calculations you really need to do for the market multiples approach. But one important thing to always keep in mind is that the thing that's going to drive your intrinsic values is going to be which stock you select as the comparable firm. Because remember, what we're doing is we're copying on the growth prospects of whatever this comparable firm is. So we don't want to copy on the growth prospects of a comparable firm that's in a different industry, or maybe they sell a different product from our firm. I mean, the most important factor to remember with this market multiples approach is that you need to find a comparable firm, a firm that is so incredibly similar to our firm that, if you just swap the name out, you wouldn't be able to tell a difference in their operations. That's that. Okay, let's see. Okay, yeah, so any other questions?
Can you go over what the goal of stock valuation for an investor is?
Yes. So the goal of stock valuation for an investor is to identify whether or not the intrinsic value of a stock is either below or above the current market price per stock. So the rule of investing as a value investor is if our intrinsic value that we just calculated, say using the market multiples approach, is greater than a market price per share, what that means is that if you calculate the expected cash flows of this firm, discount them back to the present, and that value is greater than the market price per share, if you buy that stock, then over time, you will receive the discounted cash flows that were expected, and those are going to be worth more than what you paid. In other words, if you see a situation like this, always consider buying that stock. You always want to consider additional factors, but the general rule here of stock valuation is the goal is to calculate the intrinsic value and then invest based on whether that intrinsic value is greater than the market price per share. If it's the other way around, let's say market price per share is greater than intrinsic value, then if you own shares, you might consider selling them, or you might even short shares if you don't own any. So for example, airline stocks right now might be considered stocks that you might want to short. Certainly over the last several weeks, and I mean, if they don't receive a bailout, those stocks, the intrinsic value of that stock is a stock like Delta or Norwegian Air. The intrinsic value is almost certainly going to be below the market price per share, which means you probably want to sell your shares right now.
So what's the difference between like sell and short again?
Okay, so selling means you own those shares outright. They're yours. They're in your brokerage account. Shorting, however, what that means is that you don't own those shares. And the way this works is uh, let's say you've identified a stock that is overvalued. So let's say Delta. So let's say you believe that Delta is overvalued by about 25%. And this coronavirus event is going to push the value of those shares down by 25% or so. You believe that share price is going to collapse, but you don't own shares and you want to make money on the decline of those shares. So that's where shorting comes in. When you short the shares of a stock, it's a two-part transaction. First, you borrow shares from your broker. And then as soon as you borrow them, you're going to sell them. You're going to sell them on the open market. In other words, what you're going to do, let's say with Delta, is you're going to borrow 100 shares of Delta from your broker and immediately sell those shares, which are trading at like $35 right now, for cash. You're going to get, well, whatever 50 times 35 is, like, I don't know, 1700-ish. All right, so uh, that's step one. However, since you are essentially, you have to close that transaction at some point in the next several months because you still owe your broker those shares that you borrowed from them. So at some point in the next 6 months or so, and this is really up to you, uh, that's where you close the short position. So you cover your short. So you're covering your short position by going out on the open market and then buying those 50 shares of Delta. And when you do this in an actual brokerage account, let's say an E-Trade account, most brokers are going to have a specific order type. So let's say you can buy, you can sell, you can short, and then you can also cover. And that cover transaction tells your broker you're covering this short position by buying those shares on the open market and returning them to your broker to close out this transaction. Now, the way you make money with this is if the price that you sold these shares for was more than the price that you bought them for, potentially you're going to have profited from this transaction. Now, granted, with dividends, basically any dividends that the stock pays in the interim, like while you've undertaken this short trade, you owe to your broker since you're just borrowing these shares and you need to. They are still entitled. Your broker is still entitled to those dividends during the interim. Long-winded answer, I know. All right. Next question.
So all the formulas on the like review sheet, we're gonna have those for the exam.
Yes. So let me pull those up very quickly. Yeah. So on the exam, I'll need to play around with this. Just because I've not used a Respondus lockdown browser before, so I don't know exactly where I'm going to be able to put the formulas, or if I'm going to have to ask people to print them out, which I think is a little more onerous, and I really prefer to avoid that if possible. Uh, but yeah, you will certainly have access to every single one of these formulas that you see.
So are there gonna be any questions that like of the formulas we need to like know like the intrinsic value? I don't know if the intrinsic value one is on there, but just
Uh, so I will certainly ask about the intrinsic value based on market multiples. I mean,
okay.
there's not too many questions that you can really say with certainty you're going to see, but market multiples it's about as close to a certainty as I could possibly mention.
Okay.
Uh, but no, you won't see a formula for market multiples because I mean, that's really one of those formulas that I think that everyone really should commit. Oh, I guess I stand corrected. It is on here.
Oh.
Well, in that case, since it's on here, I guess it's I consider it fair game. It'll be on the exam. So
Okay.
uh, just remember, I mean, even if I'm asking you to calculate the intrinsic value based on market multiples and you don't have earnings per share and the PE ratio, if you have some other valuation ratio, like the price to book or the price to sales, all you need to perform the market multiples process is all you need is the sales per share or the book price per share. In other words, whatever the denominator is in this ratio right here for your competitor, you just need to find the corresponding number for your firm. So if we're doing the PE ratio for your competitor, you need to find the earnings per share of your firm and then multiply the two, and that'll get you your intrinsic value. So it's a pretty easy trick to remember how to use the market multiples approach for any ratio. So yeah, yeah, that's that. So I will almost certainly also ask a couple of questions about ratios. So I might give you a set of numbers and ask you to calculate certain ratios. So just to save yourself some time, I strongly recommend that you review these ratios. I mean, some of the more important ones I'll just point out right now. Current ratio, quick ratio, those are really two that you should always have committed to memory. I guess technically you should have all of these committed to memory, but admittedly, some ratios you use in the real world more than others. Total asset turnover. This is also just your. It's sometimes referred to as just your asset turnover ratio. This is of all the efficiency ratios. This is going to be your most important one. It's just how efficient are you at converting total assets into sales revenue over the year. Also, debt to equity ratio, there's all ways to calculate this ratio. This would technically be our long-term debt to equity ratio, but it's just long-term debt on the balance sheet divided by stockholders' equity on the balance sheet. And then as we go down here, ROA, that's one of those where I almost hesitated and didn't even include it just because you should really have that committed to memory. Certainly, make sure you know that when you go into 410. I strongly recommend that because that class is, you're pretty much expected to know ratios in that class off the top of your head on the fly. So just net income, or in other words, net profit after taxes divided by total assets. ROE, another one where you should really have that committed to memory at the end of this class. So net income after taxes or net profit after taxes divided by shareholders' equity, which is the number on the balance sheet. ROE can also, so return on equity can also be decomposed into these three components that you see here. So this would be your profit margin, this would be your total asset turnover, and this would be your equity multiplier, the third ratio. So this formula that you see right here, this is what we refer to as our DuPont equation, or our DuPont decomposition. It essentially says that your profitability based on return on equity can be decomposed into how profitable your firm is, or what percentage of sales you derive, you can convert into net income, times the efficiency of your firm, times how levered your firm is based on total assets divided by shareholders' equity. So it's a way to determine why your firm has maybe a lower ROE than a direct competitor. Well, if you're less efficient than your direct competitor, well, it's going to show up here. Other ratios to consider, notice here, there's two different PE ratios. The forward PE ratio, where our dependent variable is the expected earnings per share. Where our denominator is the expected earnings per share. In this case, this is just the earnings per share that analysts believe the firm will earn over the next 12 months. This is a little different than the trailing PE ratio, because the trailing PE ratio, the denominator is earnings per share over the last 12 months. So it's earnings per share that have already been earned. Market to book ratio, just market price per share divided by book price per share. This denominator here is just equity, so shareholders' equity divided by number of shares outstanding. Price to cash flow, price to sales, two other ratios that are commonly used in the market multiples approach. Earnings per share, definitely make sure you know that one. Certainly for next semester in 410. I hear about it when my former students forget, oh wait, earnings per share is net income divided by number of shares outstanding. So just keep that one in the back of your brain. The EBITDA ratio, which is what this thing is called. This one is another popular market multiples ratio. And what it is this numerator here, this is the enterprise value of the firm. It's essentially the market value of all of the firm's assets. In other words, the market value of all of the shares of stock outstanding, plus what is technically the market value of the firm's debt, although for most firms, market value and book value of debt are very, very close. Really, the only time that's not true is when a firm's close to bankruptcy. And then we subtract out the cash, because cash is just, you can issue additional shares and increase your cash, but we just subtract that from the equation. And then in the denominator here, this is the EBITDA off of the income statement. So earnings before interest, taxes, depreciation, and amortization. And so this thing, it's a valuation ratio the same way that the PE ratio is a valuation ratio. In other words, the higher this thing is, the more someone is willing to pay for $1 of EBITDA. So if this thing is, let's say, 5, what that means is that investors are willing to pay $5 in terms of enterprise value for every $1 of earnings before interest, taxes, depreciation, and amortization on the income statement. So the higher this is, we would say the more valuable the firm is right now. Dividend payout ratio, just percentage of earnings being paid out in the form of dividends. Dividends per share, just total, I guess that's pretty self-explanatory. Total dividends divided by number of shares. And then down here we have our intrinsic value using the market multiples approach and the PE ratio. Just a very quick ratio rundown. Now, there are a couple of other formulas that you should absolutely know for the exam. The big one's going to be the CAPM. So the CAPM is just going to be well, we'll have two forms. We have two forms of the CAPM. We have the model form. And so the return on stock is equal to the risk-free rate plus the beta times the return on the market, so the return on the S&P 500 minus risk-free rate. And these risk-free rates are usually going to be US Treasury security. So maybe the 10-year T-note, maybe a T-bill, depending on the circumstance. The other CAPM form we have is the regression form. And this one essentially says that the return of the stock, RI minus the risk-free rate, in other words, the excess return on the stock, is equal to the alpha. So this is just the alpha that we care about. It's the primary measure of outperformance based on a company or a stock's beta. So it's this excess return on our stock is equal to the alpha plus the beta of the stock times the market risk premium of this. I'm sorry, there we go. My bad. That is a very easily catchable error. Okay, so the beta times the return on the market again minus the risk-free rate. So again, this entire thing would be the market risk premium. And then this E over here, this is our error term. If you remember when we used the CAPM and actually calculated alphas using regression, this E, this error term over here, this is the thing that makes every single observation balance. Every observation is going to likely have an error term, and the error term is just used to make sure that when you plug in values for every single one of those 60 observations that we used, both sides of the equation balance. This error term is also referred to as a residual. You'll talk about it in 410 if you take 410. Let's see. If I go down here, let's see what other formulas you should certainly know. Market multiples. I think those might be all. I mean, when we come back after the exam, that's where we start to get back into the formulas. But yeah, most of the formulas that we actually have are just ratios right now, at least for this exam. So they're mostly going to be here, except for what you see up here on the board. Okay, so that's that. Actually, before we go any further, why don't I talk about the particulars of the exam just very briefly? So this exam it's going to be very similar to the last one, 25 questions. I tried to get the review as close in terms of question composition as I possibly could. So notice here that there are some questions where I ask you to use some financial information. That's, well, you can probably guess where I'm going with that on the exam. Also, so I'll certainly ask questions about the CAPM. You will be allowed to use scratch paper and a calculator on the exam. I will make a note of that. So because I've not used Respondus, I don't know if you'll get some kind of error message. I think I'll probably get some message saying this student flagged. Don't worry about that. You are allowed to use scratch paper, so blank paper, and a calculator, but nothing else. So what I'll do is I'll set it so that you'll have to show your surroundings right before you take the exam. So you'll basically hold up your webcam, show that there's nothing else around you, no other people, no other second laptop to check answers on via Google, etc. So that's that. And then I'll follow up and make sure that you will have the formula sheets on the exam. So you should be able to see the formula sheet at the very end, or maybe the very beginning, depending on how I write this. But yeah, those are the particulars. You'll have an hour and a half to complete the exam. If you need more due to ADA restriction or ADA concerns, just let me know. Beyond that, the composition is going to be, in terms of quantitative or qualitative, it'll be pretty similar to last time. Maybe a few more qualitative questions than last time, just because we don't have too much quantitative information short of the ratios and the CAPM. But yeah, I mean, other than that, I think everything is pretty similar. So I'm open to answering any additional questions that you might happen to have. Okay. Well, I suppose if there's no questions, I guess we could probably call it early. Yeah. Okay. Well, yeah, I guess we will call it here, and I'll be available via Skype, and I'll certainly be on campus at some point this week. So if you need to get in touch with me, please don't hesitate. And we can set up a Skype meeting. We can talk on phone. We can talk in person. Yeah, so just let me know if you're having problems with this material, and I will do my best to address it. With that, I guess I'll call this meeting to an end. That's that. And have a good day. Good luck studying. And yeah, I guess I said it all. Take care.